You know how sometimes you see these financial headlines that seem totally random? A car lender goes bust over here, and then big tech companies are borrowing billions over there. It just feels disconnected. But what if I told you they're not? What if they're all connected? That's what we're going to do today. We're going to connect those dots and piece together what could be a very real early warning sign for the entire financial system. So our story really kicks off with a company's collapse that seemed to come out of nowhere and a pretty stark warning from one of the biggest names on Wall Street.
That's Jamie Dimon, the CEO of JP Morgan. And no, he wasn't talking about actual pests, he was talking about money. This was his take on the sudden failure of a subprime auto lender named Tricolor Holdings. A collapse that, well, it sent a real shiver through some corners of the market.
So what Dimon was really pointing to was the failure of these lenders that operate in the riskiest part of the car loan market. We're talking about companies that give loans to people with the shakiest credit. You know, this part of the market is often seen as the canary in the coal mine. It's one of the first places to show cracks when the economy starts to get wobbly. And just look at this number, 6.65%. In October, that was the share of subprime auto borrowers who were at least 60 days late on their payments. Now, according to Fitch Ratings, that is the highest that number has been since they started tracking it way back in 1994. It's a flashing red light that the pressure on everyday people is really building.
Okay, so that naturally leads to the next big question, right? Who on earth was funding all these super risky loans? And maybe more importantly, where was all that cash coming from in the first place? Well, the answer takes us into a huge but often invisible part of the financial system.
Welcome to the world of private credit. Think of it like this. It's the lending that happens behind the curtain, away from the public stock and bond markets that we all hear about. See, after the 2008 crisis, the rules for big banks got way tighter. So this private market, it just exploded.
So just how big are we talking here? Well, get this. By 2023, the total value of all these private assets, private credit included, hit a jaw-dropping $13 trillion. It has become this massive, largely unseen force shaping our entire economy. And it's not just the size, it's the speed that's just wild. This market has more than doubled in only 5 years. That's a tidal wave of money pouring into these less visible markets, all of it chasing bigger returns, and, as you can probably guess, often taking on some pretty hidden risks. And here's the key thing you gotta understand. We are talking about a multi-trillion-dollar market that's playing with a different set of rules. There's less public information, and the value of things is based on their own internal models, not what the market says second by second. This makes it so much harder for regulators and for us to know what's really going on under the hood. So who's pouring all this cash in? You might be surprised. It's the insurance industry. Yeah, U.S. insurers have over a third of their investments in these private assets. And that creates a very direct, and maybe kind of scary, link between the hidden risks of Wall Street and the insurance policies that are supposed to protect Main Street.
And this is ringing some serious alarm bells. The chairman of UBS, Colm Kelleher, is deeply concerned. He's accused insurers of something called rating shopping, which basically means they're finding ways to make risky stuff look a lot safer on paper than it really is. He's not mincing words. He calls it a looming systemic risk.
Okay, so let's switch gears for a second, but you're going to see a pattern here. This whole story of debt-fueled growth in these murky areas, it isn't just happening with car loans. A very similar thing is playing out right in the middle of the tech world.
You've seen the headlines, right? The excitement around artificial intelligence is absolutely off the charts, and it has kicked off a massive borrowing frenzy. Tech companies are loading up on billions and billions in debt to build all the data centers and infrastructure they need for this AI revolution. But here's the thing. While the hype is just deafening, some of the really smart money is getting nervous. Peter Thiel's fund, for instance, sold its entire stake in the AI chip giant NVIDIA. And Michael Burry, you know, the guy who famously bet against the 2008 housing market, is now betting against the big AI players. When guys who are famous for spotting bubbles start backing away, you gotta pay attention. I mean, the scale of this borrowing is just immense. This number, $30 billion, that was the size of a single bond sale by Meta back in October. Just one company, one deal, all to get its piece of the AI arms race.
And here is the absolute kicker. A recent MIT report found that 95% of organizations are seeing zero, that's a big fat zero, return from their investments in generative AI so far. So you have this mountain of debt being built on a promise of future profits, profits that just haven't shown up yet.
So with all this money flying around so fast into these really complicated areas, how do important details just get missed? To understand that, let's go back to that first cockroach, the tricolor collapse. There's a fascinating little story about how the problem was actually found. So check this out. You have this massive, super sophisticated global bank running the financing for Tricolor. But it wasn't their complex risk models or their top-level executives who found the fatal flaw. No, it was a junior analyst at a totally different firm, someone with fresh eyes who wasn't just going through the motions. They spotted something fishy with the loan collateral, they raised the alarm, and boom, the whole thing came crashing down. It just proves that even the biggest players can miss what's right in front of them.
And you have to remember, all of this is happening while the bigger economic picture is starting to look a little shaky. Even the Federal Reserve is now pointing to increased downside risks to employment. Put simply, if the job market weakens, that means even more pressure on anyone with a loan, whether it's for a used car or funding a tech giant.
All right, so let's pull all these threads together. We've got cracks in risky car loans, a huge, opaque private lending market fueling it all, and at the same time, a parallel debt-fueled AI boom with really questionable returns. So what does this tangled web of risk actually mean for all of us?
Well, the Financial Times tells us there are 3 really troubling trends we have to keep our eyes on. First, that growing link between these murky private markets and our real lives, through stuff like our insurance policies. Second, the growing questions about just how solid these loans are. And third, the simple, hard fact that the global economy is still pretty fragile.
When you really boil it all down, it comes to this one really unsettling idea. After the 2008 financial crisis, we didn't actually get rid of the risk. Nope, we just moved it. The regulations pushed it out of the big, highly visible banks and into the shadows of private credit, where it's much, much harder to see. And that leaves us with the big, multi-trillion-dollar question, doesn't it? This new system was, by its very design, built to hide risk from plain sight. It's been funneled into these dark corners of the market that are harder to measure and harder to see. So as these cockroaches start to crawl out, are we, and are the regulators, really watching closely enough to see the next crisis coming before it's too late?